Look, a lot of people think Bill Gates is a pretty rich guy. The reality is that the UK spends more on healthcare in 10 months than Bill Gates earned in his life. So what's my point? Governments are the biggest of big spenders. When Her Majesty's Civil Service goes on a spending spree, that's some serious shopping. Queenie is the whale in the casino. So this video is all about how governments spend serious money. And the name for government spending is fiscal policy. Where do governments get their money? Well, think of them as an individual. They can earn money, or they can borrow. When they borrow, it's called monetary policy, which is the next video. In this video, we're talking about ways they earn, and governments do this by taxation, both direct and indirect, and by selling things, everything from passports to bus tickets, and even entire industries via privatisation. For example, in 2018, the UK government sold the 5G telephone network for £1.4 billion. Now the boring bit about getting money is over. Let's do the exciting bit. Spend it. Government spending breaks down into three categories: current expenditures, capital expenditures, and transfer payments. Current expenditure is spending on goods and services that takes its full effect in that time period. Capital expenditure is the same, except the effect of the spending is felt over time. For example, hiring a nurse for a year is current expenditure. The nurse works for that year. Whereas buying a bridge is capital expenditure. The bridge will be there for more than just a year, so the benefits of the spending on the bridge last beyond the year in which it was built. Finally, transfer payments are gifts of money for which no good or service is received in return. For example, unemployment benefit or state pensions. If the government spends more than it earns, then it's running a budget deficit. And if it earns more than it spends, it's running a budget surplus. If it spends precisely what it earns, we say that it's running a balanced budget. If a government runs a budget deficit, then it has to borrow to cover that deficit. This is a bit like a person who spends more than their wage. They're going to put some debt on their credit card. The government's credit card is called government debt. So government debt is the cumulative balance of deficits and surpluses. If the UK runs a deficit of 100 billion a year for 3 years, then by the third year the UK will have accumulated a government debt of 300 billion. Some countries run regular surpluses and build up national savings, for example Abu Dhabi and Norway. We can say that these countries are fiscally responsible. By now you're familiar with the AD equation, so you know that G represents government spending and T represents government taxation. G and T are fiscal policy. So when we say that the government uses fiscal policy, what we mean is that the government is changing the level of G and T in order to change aggregate demand. When the government wants to increase aggregate demand, it increases G or decreases T or both. And this is called expansionary reflationary fiscal policy. This type of fiscal policy is used to close a negative output gap, which can also be called a deflationary gap or a recessionary gap. If the government instead wants to decrease aggregate demand, it decreases G or increases T or both, and this is called contractionary deflationary fiscal policy. This type of fiscal policy is used to close a positive output gap, which can also be called an inflationary gap or a boom. Classical economists believe that fiscal policy is unnecessary because the free market will close output gaps automatically, steering the economy back to full employment via a shift in SRAS, and thus classicals draw the LRAS as vertical. Keynesians, however, believe that fiscal policy is absolutely necessary because negative output gaps can persist in the long run, as illustrated by the ways Keynesians draw the AS curve. It's hockey stick shaped. So while classicals believe that expansionary fiscal policy will result in inflation and nothing else, Keynesians believe it will cause inflation, but also permanently increase employment. We discussed this issue in the lecture on macroeconomic equilibrium. Fiscal policy also plays an important role in stabilising business cycles through what are called automatic stabilisers. These are like the buffers at a bowling alley. They bounce the economy away from the gutter on either side. When the economy is in a boom phase, people's incomes are rising, and thus they get hit with progressively higher percentage rates of taxation. This means that taxes, T, automatically rises when an economy enters a boom, and simultaneously government spending falls, since the number of unemployed people getting unemployment benefits will fall, reducing G. This also works in reverse, with taxes falling in a recession, since as people's incomes fall, they pay progressively lower percentage rates of taxation, and in the event they lose their jobs entirely, they get unemployment benefit, which is a form of government spending, G. In short, fiscal policy automatically adjusts to run a deficit during a recession, where G increases and T decreases, and to run a surplus during a boom, where G decreases and T increases. These automatic adjustments help to smooth short-term fluctuations in the economy and dampen the amplitude of the business cycle, and so they're called automatic stabilizers. Fiscal policy is used to promote long-run economic growth, and there are three major ways this happens. First, by offering tax breaks to firms to reinvest their profits and thereby increase the quantity and quality of factors of production in the economy. Second, by creating an economic environment that's favourable to private investment. For example, by dampening the volatility of the economy and thereby increasing the confidence of households and firms. And third, by the government using its spending power to accumulate factors of production itself through capital expenditure, for example, by building a road or educating citizens. Now we know what fiscal policy is, we can ask whether it's any good. Classical economists think it's awful because it distorts the economy by moving money away from private entrepreneurs and towards inefficient government bureaucrats, and will not have a long-term impact on economic output. A second weakness of fiscal policy is that when the government starts buying goods and services directly, it competes with private entrepreneurs for factors of production. This is called crowding out. A third weakness of fiscal policy is that it takes a while for spending to filter through, whereas monetary policy causes an immediate change in behaviour. Imagine what you'd do if you heard the interest rate had suddenly risen to 20%. A fourth weakness of fiscal policy is that it's very political, with politicians and voters often being ideologically opposed to taxes or to balancing a budget, which can mean that governments using fiscal policy create an ever larger government debt. Nevertheless, there are some good things about fiscal policy. Firstly, Keynesians believe that only by the government using fiscal policy can we get out of a downward spiral of low confidence that would otherwise bring the circular flow to a halt. This is because fiscal policy influences aggregate demand directly rather than relying upon households and firms to respond to a change in interest rates. Secondly, fiscal policy can be used to target particular industries or geographical areas, or social groups, which can improve both efficiency and equity. And this is really important because by training historically disadvantaged groups, such as northern inner cities in the UK, fiscal policy can both increase the quality of the nation's labour supply, and thus shift the PPF outwards, and also reduce income inequality. It's one of those rare but precious examples where promoting equity also promotes efficiency. And that's it for fiscal policy.